Warren Buffett is known around the world as one of the greatest investors of all time. But his success is not just about picking stocks or building wealth. It is about a way of thinking, a way of living, a way of staying calm while others rush. He built his fortune slowly, step by step, with patience and discipline. He did not look for shortcuts or secret tricks. Instead, he trusted time, knowledge, and good decisions. He once said that the stock market is designed to transfer money from the impatient to the patient. That one line holds the heart of his philosophy. Buffett's journey began when he was a young boy in Omaha. He read every book he could find about money and business. He bought his first stock before he was a teenager. But what made him special was not his early start. It was his mindset. He treated investing as a lifelong game of learning. Unlike many who chase trends, Buffett looks for value that lasts. He studies companies deeply, understands how they earn money, and waits for the right time. He does not react to market noise. He focuses on facts, not feelings. This is why he says that emotional control is more important than intelligence in investing. Over the years, Buffett's calm and thoughtful approach has turned simple ideas into great fortunes. He believes that ordinary people can become successful investors if they follow timeless principles. His lessons are not complicated. They are built on common sense, patience, and trust in the power of time. In this audiobook, we will walk through those lessons step by step. Each chapter shares a simple truth that can change how you think about money and life. Whether you are a new investor or someone with years of experience, Buffett's ideas can help you grow. They will show you that success does not come from speed, but from understanding. Not from luck, but from discipline. So let us begin this journey into the mind of Warren Buffett. Let us explore the principles that made him the Oracle of Omaha. Let us understand how his patience shaped one of the greatest fortunes in history. Now, we begin with the first and most powerful lesson of all. Chapter 1. The Power of Patience. Warren Buffett often says that the stock market is a device for transferring money from the impatient to the patient. This simple idea captures the foundation of his success. Patience is not just waiting. It is the ability to stay calm, disciplined, and focused while time does the work. Buffett understands that real wealth is built slowly through consistent and intelligent decisions, not through quick wins or speculation. In the world of investing, many people seek instant results. They buy when the market rises and sell when it falls, constantly reacting to short-term noise. Buffett does the opposite. He studies businesses carefully, buys when prices are reasonable, and then holds his investments for many years. He trusts the process and allows time and compounding to create value. Patience also helps investors avoid emotional mistakes. When the market drops, fear pushes many to sell. When prices rise, greed pushes others to buy recklessly. Buffett remains calm in both situations. He knows that emotions destroy more wealth than bad investments. His calm nature allows him to think clearly, make rational choices, and act when others panic. Another aspect of patience is long-term vision. Buffett does not aim for quick profits or short-term excitement. He looks for companies that can grow steadily over decades. He understands that real success comes from holding great businesses, not chasing trends. By giving his investments time to grow, he benefits from compounding, the process where profits earn more profits. Compounding rewards patience. It begins slowly, but grows faster as time passes. For example, if an investment grows a little each year, that small growth multiplies over decades. Buffett calls this the eighth wonder of the world, because it works silently and powerfully for those who wait. Patience is not just about waiting. It is about believing in your strategy. Buffett has spent years studying markets, learning from mistakes, and refining his approach. This preparation gives him confidence to stay patient even during difficult times. He knows that great results require time and consistency, not luck or shortcuts. Patience also applies beyond investing. In business, relationships, and learning, results take time. Rushing leads to stress and poor decisions, while patience allows steady improvement. Buffett's calm, deliberate way of working reflects his belief that time is the most powerful ally for success. To develop patience, One must focus on process, not outcomes. Buffett reads, studies, and thinks before acting. He avoids distractions and stays committed to his principles. He once said, "The stock market is designed to test your patience." Those who pass this test reap the greatest rewards. The lesson from Buffett's life is clear. Patience builds confidence, reduces mistakes, and magnifies results. It allows knowledge, experience, and money to compound naturally. While others rush and worry, the patient investor quietly grows wealth over time. In a fast world filled with instant gratification, Buffett's calm and patient mindset stands out. He reminds us that success is not about doing more. It is about doing the right things and giving them time to work. Patience turns small efforts into massive results, both in investing and in life. Now that we understand the value of patience, the next chapter explores another key Buffett principle: knowing what you own. Understanding your investments deeply is the next step toward long-term success. Chapter 2: Understanding what you own. Warren Buffett never invests in something he does not fully understand. He calls this rule staying inside your circle of competence. It means focusing only on businesses you truly know. If you cannot explain in simple words how a company makes money, you should not buy its stock. This simple rule has protected Buffett for decades. Many investors make the mistake of chasing trends. They hear about new industries, new technologies, or hot stocks that everyone talks about. They rush to invest without learning how those businesses actually work. They hope for quick profits, but hope is not a strategy. Buffett believes understanding is more powerful than excitement. You should know what drives the business before you put your money into it. Buffett learned this lesson early in life. As a young man, he was inspired by his teacher Benjamin Graham, who taught him the importance of research and value. But Buffett took this further. He realized that real understanding comes from studying the business deeply. He does not just look at stock prices. He looks at the company's products, customers, competitors, and management. He wants to know how the business earns money and why people will keep paying for its products in the future. When Buffett bought shares of Coca-Cola, he was not guessing. He understood the brand's global power. He knew that people loved the drink and that its recipe, though simple, created massive customer loyalty. He could see that the brand had a long future ahead. He said he liked to invest in businesses so simple that even a fool could run them, because one day a fool might. That is how well he wants to understand a company before investing. Understanding also helps during bad times. When the market falls, most investors panic. They sell everything because they do not truly know what they own. Buffett stays calm because he knows the real value behind his holdings. If he understands the business is strong, temporary price drops do not scare him. He uses those moments to buy more. Buffett says you should think like a business owner, not a trader. When you buy a stock, you are not just buying a symbol on a screen. You are buying a part of a real company with employees, products, and goals. Would you buy a business you do not understand in real life? Of course not. So why do it in the stock market? This simple mindset protects investors from unnecessary risks. He avoids businesses that are too complicated or unpredictable. For example, he stayed away from many technology companies for a long time because he could not predict their future. He said, "There is no need to swing at every pitch. Wait for the ones you understand and can hit with confidence." In investing, it is not how many times you swing, but how many good decisions you make. Understanding what you own also means knowing when not to invest. Sometimes, the best decision is to do nothing. Buffett says the market does not reward activity. It rewards accuracy. He spends much of his time reading and thinking, not trading. He waits until he fully understands a company's long-term potential. Then he acts with conviction. This level of understanding builds trust in your decisions. When you know your investments deeply, you will not panic when prices fall or news changes. You will have peace of mind because your choices are based on knowledge, not emotion. You will see your stocks as living businesses, not just numbers. So the next time you think of investing, ask yourself a simple question. Do I really understand what I own? If the answer is no, spend time learning. Read more. Ask questions. Study the company like Buffett does. Because true understanding is your best defense in the market. Now that we know the value of understanding, it is time to explore another secret behind Buffett's success. It is a quiet force that turns time into wealth and small profits into great fortunes. Let us move to the next chapter. Chapter 3. The Magic of Compounding. Warren Buffett calls compounding the most powerful force in finance. It is the quiet magic that turns small beginnings into great fortunes. Compounding means that your money earns profits, and those profits start earning more profits. Over time, this growth becomes larger and faster, like a snowball rolling down a hill. The longer it rolls, the bigger it becomes. Buffett started investing when he was a young boy. He bought his first stock as a child and kept learning about money. By the time he was a teenager, he already understood that time was his biggest advantage. He knew that even a small amount of money, if invested wisely and left untouched, could grow into something huge. He once said that you only need to do a few things right in life as long as you do not do too many things wrong. Compounding is one of those few things that must be done right. To understand compounding, imagine planting a tree. At first, it is just a tiny seed. You water it, care for it, and protect it. In the beginning, it looks small and slow. But with time, it grows taller, stronger, and begins to bear fruit. That fruit contains more seeds, which can grow into more trees. This is how wealth grows through compounding. The secret is patience and consistency. Buffett's wealth is a perfect example of compounding in action. For decades, he kept reinvesting his earnings into new opportunities. He did not take money out or chase short-term gains. Instead, he allowed his profits to build upon themselves year after year. Most of his fortune came after many decades of steady growth, not in the early years. This is why he often says that time is the friend of the wonderful business. Compounding does not only apply to money, it also applies to knowledge and habits. Buffett reads every day and learns something new. He believes that knowledge compounds just like money. The more you learn, the more connections your mind makes, and the smarter your decisions become. Each small improvement adds up to big results over time. Good habits also compound. A single act of discipline today creates a better tomorrow, which builds into a better life. Most people underestimate compounding because it starts small. They want fast results and big rewards now. But Buffett's success shows that slow and steady wins the race. He once said that the stock market is a place where the patient get rich and the impatient lose money. The key is to start early and stay consistent. Even a small investment, if left to grow over decades, can become something extraordinary. Buffett also warns that compounding can work in reverse. Debt, bad habits, and poor decisions can also grow over time. If you borrow too much or make repeated mistakes, your problems multiply. So you must use compounding wisely. Feed it with good choices, not bad ones. He believes that compounding is not just about numbers, it is about mindset. It teaches you the value of time, the importance of discipline, and the reward of patience. It encourages you to think long-term and to resist the temptation of quick wins. It reminds you that greatness is built little by little. The magic of compounding turns ordinary investors into extraordinary ones. It rewards those who trust time and stay consistent. Buffett's entire fortune is proof that simple actions, repeated for a long time, create miracles. You do not need to be a genius to benefit from compounding. You only need to start, stay patient, and let time do the work. Now that we understand the magic of compounding, we must learn how to choose what to invest in. Because compounding only works well when the foundation is strong. The next lesson from Buffett teaches us exactly that, how to pick the right kind of company. Let us continue to the next chapter. Chapter 4. Buy great companies, not just cheap ones. One of Warren Buffett's most important lessons is that it is better to buy a wonderful company at a fair price than a fair company at a wonderful price. In other words, do not focus only on cheap stocks. Look for quality first. Price is important, but the long-term strength of the business matters more. Early in his career, Buffett followed his teacher Benjamin Graham's advice. He looked for bargains, companies that were undervalued compared to their assets. This approach worked for a while, but over time, Buffett realized that buying cheap companies could be risky. Some companies look cheap for a reason. They may have weak management, declining products, or shrinking markets. No matter how low the price, they may not recover. Buffett changed his approach. He began looking for businesses with strong competitive advantages, consistent earnings, and good management. He wanted companies that could grow steadily for decades. These are the businesses that compound value over time. They are easier to understand, more predictable, and safer for long-term investment. A great company has qualities that last. It may have a strong brand, loyal customers, a unique product, or a cost advantage over competitors. These qualities protect it from competitors and economic challenges. Buffett calls this a moat, which he explains more in the next chapter. Companies with moats can maintain profits and grow even during difficult times. Buffett's investment in Coca-Cola is a perfect example. He did not buy it because the stock was cheap at the moment. He bought it because he understood the business, trusted the management, and knew that people all over the world loved the brand. Over decades, Coca-Cola has continued to earn money and grow. This is the power of buying great companies. Buying strong companies also allows investors to think long-term. When you invest in a business with solid fundamentals, you are not worried about daily price movements. You know that over years, the company's value will grow. You can hold it for decades, allowing compounding to work its magic. Buffett's favorite holding period is forever. This strategy only works if the company is great, not just cheap. Buffett avoids companies that depend on trends or speculation. He does not invest in businesses he cannot understand or predict. He avoids technology stocks for a long time because their future was uncertain. He prefers companies that have proven business models, reliable customers, and consistent profits. Price is still important, but quality is more important. Buying a mediocre company cheaply may create short-term gains, but over time, it can lead to losses. Buying a strong company at a fair price allows your investment to grow safely and steadily. It gives your money a chance to work for you for years without constant worry. Buffett also emphasizes patience when buying great companies. You may need to wait for the right opportunity. The stock price may rise or fall, but if the business is strong, it is worth waiting for the right price. Do not rush. Do not follow the crowd. Understanding quality and value is more than a financial exercise. It requires observation, research, and judgment. It requires thinking like an owner, not a trader. When you buy a great company, you are buying part of a business that will create wealth steadily over decades. Once you grasp this principle, the next step is to look at what protects a company from competitors. This is the idea of a moat, which makes good companies even better investments. The next chapter explains this concept in detail. Chapter 5. The moat concept. Warren Buffett often talks about the importance of a moat in a business. A moat is like a protective barrier around a castle. It keeps competitors away and protects the company's profits. The stronger the moat, the safer the business and the more reliable the investment. Buffett looks for companies with durable competitive advantages. These are businesses that can maintain high profits over many years. A moat can take many forms. It could be a strong brand that customers trust, like Coca-Cola. It could be a unique product that no one else can easily copy. It could be cost advantages, patents, network effects, or even customer loyalty. Why is a moat so important? Because businesses without protection are vulnerable. Even good companies can fail if competitors copy their products or steal their customers. A strong moat allows a company to grow steadily and protect its value. Buffett believes that investing in companies with wide moats reduces risk. It is one of the reasons he holds businesses for decades. Buffett studies every aspect of a company to understand its moat. He looks at its history, products, customers, and market position. He asks questions like, why do customers choose this company over others? What prevents competitors from taking market share? If he sees a durable advantage, he gains confidence that the company will continue to perform well. One example is Geico, the insurance company Buffett invested in early. It had low costs and a strong brand, giving it a significant advantage over competitors. Even when other companies tried to compete, Geico continued to grow. Buffett recognized the moat and used it as a foundation for a long-term investment. A moat is not only about profits, it is about sustainability. Companies with strong moats can weather economic downturns, competition, and changes in the market. They can keep earning money while weaker companies struggle or fail. This makes investing in them safer and more predictable. Buffett also warns that moats are not permanent. Businesses must continue to innovate, serve customers, and protect their advantage. A moat can shrink or disappear over time if the company becomes careless. Investors must monitor the business to ensure its moat remains strong. Wide moats allow investors to focus on the long term. When a company is protected, short-term price changes matter less. The true value lies in the business itself, not the stock market fluctuations. Buffett can hold companies for decades because he trusts their moats. The concept of a moat also applies to the investor's mindset. Just as companies need protection from competition, investors need protection from emotional mistakes. Patience, understanding, and discipline are like personal moats that guard your wealth. Buffett combines these personal habits with strong businesses to build lasting success. In short, a moat is a measure of quality and durability. It is what separates great companies from ordinary ones. Investors who understand moats are more likely to choose businesses that grow safely over time. The next lesson builds on this idea. Even if a company has a strong moat, emotions can destroy rational decisions. Buffett teaches that controlling your emotions is just as important as choosing a protected business. This brings us to the next chapter. Chapter 6. Emotional Control. Warren Buffett believes that emotional control is one of the most important skills for an investor. He often says that investing is not a game of intelligence, but a game of temperament. Most people fail in the market not because they do not understand companies, but because they let fear and greed control their decisions. Fear can make investors sell too quickly. When stock prices drop, many panic. They imagine the worst and rush to get out, even if the company is strong. Buffett, on the other hand, stays calm. He understands that short-term price changes do not affect the true value of a business. A strong company will recover over time, and panicking only turns temporary losses into permanent ones. Greed works in the opposite way. When prices rise and everyone around you is making money, it is easy to get caught up. People buy stocks without understanding them, hoping for quick profits. Buffett warns against this. He says the market often overreacts in both directions, creating opportunities for disciplined investors. Being greedy at the wrong time can lead to mistakes, losses, and regret. Buffett compares the stock market to a roller coaster. It goes up and down constantly, but you do not have to get off every time it dips. If you remain seated and enjoy the ride, you can reach your destination safely. Emotional control allows investors to ride the market calmly instead of reacting impulsively. He also practices what he preaches in his personal life. Buffett lives simply, avoids unnecessary stress, and does not chase every new opportunity. This calm mindset reflects in his investments. He makes decisions slowly, carefully, and only when he has confidence. He says, "The stock market is designed to test your patience and discipline." Those who fail are often the ones who let emotions drive them. Buffett uses rules to help control emotions. For example, he only invests in companies he understands. He only buys when the price is reasonable. He holds for the long term and avoids reacting to short-term news. These rules create a framework that limits impulsive decisions. When rules guide you, emotions have less power. Another important aspect of emotional control is humility. Buffett admits his mistakes openly. He studies them carefully to avoid repeating them. Acknowledging errors and learning from them prevents fear and regret from influencing future decisions. This practice makes him confident without being reckless. Emotional control also allows Buffett to take advantage of market opportunities. When others panic and sell, he sees a chance to buy strong companies at lower prices. When others are greedy and overpay, he waits patiently. He does not follow the crowd. He does the opposite when necessary, which is a hallmark of successful investing. Buffett's calm mindset also comes from preparation. He reads constantly, analyzes carefully, and has a clear plan. Knowledge reduces uncertainty, and reduced uncertainty reduces fear. Confidence built on knowledge is stronger than confidence built on hope or speculation. In the end, emotional control is the bridge between knowledge and success. Even if you understand a business perfectly, impulsive decisions can ruin your returns. Even the best investment can fail if fear or greed drives your actions. Buffett shows that the key to lasting success is keeping your mind steady, disciplined, and focused on facts, not feelings. Now that we understand the importance of controlling our emotions, we can see why patience and discipline matter most over the long term. The next chapter shows how Buffett combines these habits into a strategy that focuses on the future, not daily market noise. Chapter 7. The Long-Term Mindset. Warren Buffett's success is built on thinking long-term. He does not buy stocks to make a quick profit. He buys businesses to own a part of them for many years, sometimes forever. This mindset allows him to ignore short-term market swings and focus on real value. Buffett believes that time is the friend of a wonderful business and the enemy of a poor one. Strong companies grow slowly but steadily. Weak companies may look cheap or promising at first, but over time they often fail. By focusing on long-term growth, investors can avoid unnecessary stress and mistakes caused by short-term fluctuations. The stock market is often emotional. Prices rise and fall based on rumors, news, or investor sentiment. Most people react to these movements. They buy when others are greedy and sell when others are fearful. Buffett does the opposite. He ignores daily price changes and concentrates on the fundamentals of the business. A long-term mindset also allows compounding to work its magic. When you hold a great business for years, profits grow, and those profits generate more profits. Over time, small gains multiply into enormous wealth. Buffett often says that the biggest gains in the stock market come from holding quality companies for decades. Buffett's approach is simple, but requires discipline. He studies companies carefully, chooses only the best ones, and then waits. He does not panic during market downturns. He does not sell because of temporary fear or excitement. He knows that real wealth comes from steady growth over long periods. One example is his investment in American Express. Buffett bought it when the company faced challenges and its stock price fell. Most investors avoided it out of fear. But Buffett recognized the company's long-term value. He held on, and over decades, it became one of his most successful investments. This would not have been possible without a long-term perspective. Thinking long-term also reduces unnecessary trading. Frequent buying and selling increase costs and reduce returns. Short-term decisions are often influenced by emotion rather than logic. By holding investments for years, Buffett avoids these mistakes. He does not try to time the market or predict every movement. He focuses on businesses that will be strong in the future. A long-term mindset requires patience and confidence. It means trusting your research and understanding of the business. It means accepting that results may not appear immediately. It means being comfortable with uncertainty and resisting the urge to react to every news headline. Buffett also applies this mindset to his personal life. He lives simply and avoids unnecessary complexity. He focuses on steady growth, learning, and relationships. This philosophy reflects his investment style. Slow and consistent actions create the greatest long-term results. Another advantage of a long-term mindset is clarity. You can evaluate investments based on their true worth, not daily market fluctuations. You can measure performance by the company's growth, profits, and strength, rather than temporary prices. This reduces stress and improves decision-making. In a world of instant results and rapid change, Buffett's long-term approach may seem unusual. Most people want fast returns and immediate satisfaction. Buffett shows that patience, discipline, and a focus on the future are far more powerful than speed. Now that we understand why thinking long-term is essential, we can see why knowledge and learning are equally important. A patient investor still needs wisdom to choose the right businesses. The next chapter explains the value of reading and continuous learning in Buffett's life. Chapter 8. The Value of Reading. Warren Buffett is one of the most famous investors in the world, but his success is not only due to talent or instinct. It is largely because of his lifelong habit of reading. Buffett spends most of his day reading newspapers, financial statements, and books. He says that knowledge compounds just like money. The more you learn, the better decisions you can make. Buffett began reading as a child. He was curious about business, money, and how the world works. Even as a young boy, he read books about investing, companies, and numbers. By the time he was a teenager, he had already absorbed years of knowledge that most people learn later in life. This early start gave him an advantage that grew over decades. Reading is a habit, not a task, in Buffett's life. He reads several hours every day. He studies company reports carefully, looks at earnings, and understands how businesses operate. He reads newspapers to stay informed about the economy, industries, and global trends. He also reads history, biographies, and books about human behavior. All of this reading helps him make smarter investment decisions. Buffett believes that learning never stops. Even as a billionaire, he continues to read constantly. He says that the world changes, companies evolve, and markets behave differently over time. To make good decisions, you must keep learning. Knowledge is a tool that grows stronger with use, just like money when it is invested wisely. Reading also builds perspective. It allows Buffett to see patterns, understand risks, and anticipate challenges. He can compare companies, industries, and economic cycles because he has read widely. This perspective reduces mistakes and helps him identify opportunities that others miss. Buffett once said that he spends 80% of his day reading and thinking and 20% doing. Most investors spend the opposite. They react quickly to market news without taking the time to understand it. By reading and reflecting, Buffett can make calm, informed decisions instead of impulsive ones. Knowledge gives him confidence, and confidence reduces fear. Reading also strengthens the ability to analyze. Buffett studies financial statements, profit margins, and company reports carefully. He does not rely on tips or trends. He understands the numbers, the business model, and the long-term potential. This deep knowledge allows him to spot strong companies and avoid weak ones. Buffett's love for reading shows that investing is more about wisdom than luck. Even in a world of complex technologies and fast-moving markets, he achieves success by using simple tools: patience, understanding, and knowledge. Books and reading are the foundation of this approach. Reading is not limited to business. Buffett also reads about human behavior, history, and leadership. This helps him understand people, markets, and decisions. Investing is not just about numbers. It is about understanding humans, customers, managers, and competitors. Reading teaches these lessons in ways that experience alone cannot. By making reading a daily habit, Buffett compounds his knowledge over time. Small lessons learned today add to the wisdom of yesterday, creating a powerful advantage. Just like money in the market, knowledge grows and multiplies if you invest consistently. The next chapter builds on this idea. Knowledge and reading are powerful, but Buffett also understands the importance of staying free from unnecessary debt. Debt can destroy the advantage of patience, compounding, and wisdom. Let us continue to the next chapter. Chapter 9. Avoid debt. Warren Buffett believes that avoiding unnecessary debt is one of the keys to financial success. He often says that debt can be dangerous, even for experienced investors. Borrowing money may seem like a shortcut to wealth, but it can quickly destroy it if not handled carefully. Debt forces you to take risks that you might not be ready for. When you borrow money to invest, you face pressure to earn returns quickly. This can lead to poor decisions. Fear of losing borrowed money can make you sell at the wrong time. Greed can push you to take excessive risks. Both outcomes are dangerous for long-term wealth. Buffett himself avoids personal debt. He lives simply and does not rely on credit for his lifestyle. He buys things he can afford and invests the rest. This freedom allows him to make calm and rational decisions. He is not pressured by monthly payments or interest rates. He can focus on long-term goals instead of short-term needs. The same principle applies to businesses. Buffett prefers companies with little or no debt. Companies that borrow heavily may struggle when profits drop or interest rates rise. Even strong companies can be damaged by excessive leverage. On the other hand, companies with low debt have flexibility. They can invest in growth, survive difficult times, and take advantage of opportunities. Buffett also warns that debt can work against compounding. Money borrowed must be repaid with interest. Even if an investment grows, paying interest reduces the effective gains. In some cases, debt can destroy wealth faster than it creates it. By staying debt-free, you allow your money to work for you without interference. Avoiding debt also reduces stress. Financial pressure can cloud judgment and lead to emotional decisions. Investors who are free from debt can remain calm during market volatility. They can take advantage of opportunities while others are panicking. This is one reason Buffett can buy great companies when prices are low. Buffett's advice is simple but powerful. Live within your means. Do not borrow money for unnecessary expenses. Invest what you have wisely and let it grow over time. Avoiding debt preserves both financial security and mental clarity. Debt can be tempting. Credit cards, loans, and borrowing for investment often seem like easy solutions. But Buffett shows that the short-term convenience is rarely worth the long-term risk. He believes that financial freedom comes from control over your money, not dependence on borrowed funds. In business, companies must also manage debt carefully. A profitable company with high debt can fail during a downturn. A smaller company without debt may survive and even thrive. Buffett looks for businesses with strong balance sheets because they are safer and more likely to grow steadily. By avoiding debt, you also create opportunities. When others are struggling with interest and repayments, you can invest, expand, or take advantage of bargains. Freedom from debt creates freedom of choice. Buffett uses this principle both in his personal life and in Berkshire Hathaway's investments. Ultimately, avoiding debt is about discipline and long-term thinking. It protects you from mistakes and allows your money to grow without unnecessary risk. It is a simple rule, but it has enormous impact over decades. The next chapter shows another important part of Buffett's philosophy. Even if you avoid debt, it is equally important to keep your approach simple. Complex strategies and confusing products often lead to mistakes. The next chapter explains this principle. Chapter 10. The Power of Simplicity. Warren Buffett believes that simplicity is one of the most powerful tools in investing. He avoids complex financial products, strategies, and businesses that are hard to understand. Buffett says, if you cannot explain how something works in simple terms, you should not invest in it. Complexity often hides risk, and risk can destroy wealth. Buffett prefers businesses that are easy to understand and predict. He wants to know how a company makes money, who its customers are, and what its long-term potential is. If the business is simple and clear, he can focus on its value rather than getting distracted by complicated details. This approach reduces mistakes and makes decision-making easier. Simplicity also saves time and energy. Investing can be complicated if you try to follow every trend, read every report, and react to every market movement. Buffett spends his time studying companies he understands deeply. He does not try to follow the crowd or chase the latest fad. By keeping things simple, he can focus on what really matters, choosing strong businesses and holding them for the long term. Buffett's approach is often called buy what you know. He invests in industries and companies that are familiar to him. This allows him to make confident decisions and avoid unnecessary risk. He does not need complicated formulas or predictions because he understands the business fundamentals. Knowledge plus simplicity equals clarity. Another reason simplicity works is that it makes it easier to remain disciplined. When strategies are too complex, it is easy to make mistakes. Rules become confusing, and emotions take over. By keeping the investment process simple, Buffett can follow his principles consistently. He buys good companies, waits patiently, and lets time and compounding work. Buffett also applies simplicity in life, not just investing. He lives in the same house he bought decades ago, drives modest cars, and avoids extravagant spending. This simple lifestyle reflects his philosophy. Avoid unnecessary complexity and focus on what truly matters. By living simply, he reduces distractions and stays focused on his long-term goals. Simplicity also helps in understanding risk. Complicated strategies often hide potential losses. Simple businesses with clear earnings and predictable growth are easier to analyze. You can measure their performance and make informed decisions. You know what you are buying, and you understand the potential rewards and dangers. Buffett's love for simplicity also explains his preference for long-term investing. He does not try to predict market movements or trade frequently. He focuses on companies with strong fundamentals and allows them to grow steadily. This approach is simple, logical, and effective. In summary, simplicity is a guiding principle in Buffett's life and investing. It reduces risk, improves clarity, and strengthens discipline. It allows investors to focus on quality rather than noise. It makes decision-making easier and helps avoid mistakes caused by overthinking or following trends. Once you combine simplicity with patience, understanding, and emotional control, you have a powerful strategy. The next chapter shows another essential aspect of Buffett's approach: choosing and trusting the right management. Chapter 11. Focus on quality management. Warren Buffett believes that the quality of a company's management is as important as the business itself. Even the best business can fail if it is run poorly. Conversely, a strong and honest management team can guide a company through challenges and help it grow over time. Buffett looks for managers who are talented, disciplined, and trustworthy. He wants leaders who make decisions in the long-term interest of shareholders rather than seeking short-term personal gains. Managers should be transparent about the company's performance, risks, and plans. Buffett often says that he invests in people, not just numbers. A good management team has integrity. They do what they promise, follow rules, and act ethically. Buffett avoids companies where management is secretive or manipulative. Trust is essential in investing. If you cannot trust the people running the business, it is too risky to invest, no matter how strong the company appears. Buffett also values managers who allocate capital wisely. Capital allocation means deciding how to use the company's money to grow profits. Good managers invest in profitable opportunities, buy back shares when appropriate, or pay dividends responsibly. Poor managers waste money, take unnecessary risks, or focus on vanity projects. Buffett studies how managers have handled money in the past to predict how they will behave in the future. One famous example is his investment in Berkshire Hathaway. Buffett originally bought the company when it was struggling, but he noticed the management style and opportunities for improvement. He eventually took control and applied his principles of careful capital allocation, patience, and focus on strong businesses. This decision turned Berkshire into one of the most successful companies in the world. Buffett also appreciates managers who communicate clearly and honestly with shareholders. He values transparency and dislikes companies that try to confuse investors with jargon or unnecessary complexity. When management explains the business in simple, understandable terms, it shows that they truly understand what they are doing. Another quality Buffett looks for is stability. He prefers managers who plan for the long term and avoid chasing short-term trends. Short-term thinking can harm the business and erode value. Managers who act responsibly during both good and bad times create trust and reliability, which are crucial for long-term investing. Buffett also gives managers freedom to run their businesses effectively. He avoids micromanaging or interfering with daily operations. He trusts capable managers to make the right decisions, but he monitors results carefully. This trust-based relationship allows the company to grow while keeping investors informed. In essence, quality management is a moat in itself. A talented and honest team strengthens a company's competitive advantage, protects profits, and guides growth. It reduces risk and increases the likelihood of long-term success. Investors often overlook management quality, focusing only on numbers or market trends. Buffett teaches that without the right people at the top, Even the strongest business can fail. By studying management carefully, investors can make wiser decisions and increase the probability of long-term gains. Now that we understand the importance of strong leadership, it is equally important to learn when to ignore distractions in the market. Buffett emphasizes that paying attention to noise can destroy returns. The next chapter explores this principle. Chapter 12. Ignore market noise. Warren Buffett believes that most investors make mistakes because they pay too much attention to market noise. Prices fluctuate daily, news spreads quickly, and opinions change constantly. Most people react to every piece of information without thinking carefully. This behavior often leads to poor decisions, stress, and losses. Market noise is the constant stream of information that distracts investors. It includes news headlines, rumors, economic predictions, and social media opinions. While some of this information is useful, most of it is short-term, confusing, or misleading. Buffett warns that reacting to every market movement is a trap. Investing is not about predicting the next headline. It is about understanding the long-term value of businesses. Buffett compares the stock market to a voting machine in the short term and a weighing machine in the long term. In the short term, prices go up and down based on popularity, emotions, and speculation. This is the voting machine, influenced by noise and public opinion. In the long term, however, the true value of a company, its earnings, growth, and competitive advantage, determines the outcome. This is the weighing machine, and it ignores temporary fluctuations. Ignoring market noise requires emotional control and patience. When prices drop suddenly, most investors panic. They sell because they fear losing money. When prices rise rapidly, many rush to buy out of greed. Buffett does the opposite. He focuses on the fundamentals of the company and ignores daily price movements. Short-term swings do not change the underlying value of a strong business. One famous example is the 2008 financial crisis. Many investors panicked and sold stocks at low prices. Buffett saw opportunity. He bought shares of strong companies when prices were low, understanding that the market panic was temporary. Years later, those investments generated enormous returns. This would not have been possible without ignoring market noise. Buffett also avoids following the crowd. Trends, hot stocks, and popular opinions often attract attention but carry high risk. Investors who chase trends are influenced by emotion rather than logic. Buffett teaches that it is better to be cautious and thoughtful than to follow the herd blindly. Another way to ignore market noise is to focus on what you can control. You cannot predict every economic report, government decision, or market reaction. But you can control how much you invest, what businesses you choose, and how patiently you hold them. By focusing on your own decisions, you reduce stress and increase the chance of success. Buffett also emphasizes the importance of long-term thinking in ignoring noise. Short-term volatility may seem alarming, but it has little impact on the long-term performance of great companies. By keeping a long-term perspective, you see temporary drops as opportunities and avoid unnecessary panic. In addition, ignoring market noise reduces unnecessary trading. Frequent buying and selling increases costs and lowers returns. It also exposes investors to emotional mistakes. Buffett avoids trading based on market sentiment and focuses on the real value of businesses. Ignoring market noise is a combination of patience, discipline, and knowledge. It allows investors to remain calm during market swings, focus on strong companies, and make rational decisions. Buffett's ability to tune out distractions is one of his greatest advantages in investing. Now that we understand why market noise should be ignored, the next chapter teaches an important principle about behavior. Buffett says that sometimes fear can be your friend, and greed can be your enemy. Understanding this can help investors act wisely when others panic. Chapter 13. Be fearful when others are greedy. One of Warren Buffett's most famous rules is simple. Be fearful when others are greedy, and be greedy when others are fearful. This principle highlights the importance of acting differently from the crowd. Most investors make mistakes because they follow emotions instead of logic. When everyone else is excited and buying stocks, prices often become too high. When fear dominates and people sell, opportunities appear at attractive prices. Greed leads people to overpay. They chase hot stocks, trends, or fads without understanding the business. They hope for quick profits and ignore risks. Buffett calls this dangerous because it increases the chance of losses. When others are greedy, it is time to slow down, analyze carefully, and avoid joining the herd blindly. Fear, on the other hand, creates opportunity. When markets drop and investors panic, prices often fall far below the true value of strong businesses. Most people sell out of fear. Buffett sees this as a chance to buy quality companies at discounted prices. This behavior requires courage, patience, and confidence in your analysis. Buffett's investment in American Express during a crisis is a clear example. The company faced challenges, and most investors sold their shares. Buffett recognized that the business had strong fundamentals, loyal customers, and a competitive advantage. He invested heavily when others were fearful, and over time, the investment became highly profitable. This demonstrates the power of acting contrary to the crowd. This principle also applies to individual psychology. Investors often feel pressure to act when everyone else is moving. Media headlines, popular opinions, and social conversations influence emotions. Buffett teaches that success requires independence. You must make decisions based on facts, research, and long-term thinking, not on the actions of others. Being greedy when others are fearful is not reckless. It is calculated risk-taking. Buffett studies the business carefully, ensures the fundamentals are strong, and then acts when prices are low. This disciplined approach separates smart investors from the majority who react emotionally. Buffett also warns that acting opposite to the crowd is uncomfortable. Fear and greed are powerful emotions. Going against popular opinion can feel lonely or risky. But long-term investors understand that discomfort is often a sign of opportunity. The market rewards those willing to be patient and rational when others are emotional. This principle requires preparation. You cannot act when fear appears if you do not already know which businesses are strong. Understanding what you own, knowing its value, and recognizing its competitive advantage allows you to take advantage of fearful markets confidently. Buffett's rule also works over decades, not just days. Markets have cycles of fear and greed repeatedly. By consistently following this principle, an investor can buy strong companies cheaply during downturns and avoid overpaying during booms. This disciplined approach compounds wealth over time. Being fearful when others are greedy and greedy when others are fearful also reinforces emotional control. It strengthens patience, confidence, and discipline, all traits Buffett emphasizes in investing. It is a mindset that separates successful long-term investors from short-term speculators. Now that we understand the importance of acting contrary to the crowd, the next chapter teaches how relationships can amplify success. Buffett believes in building connections, trust, and partnerships that compound just like money. Chapter 14. The Power of Compounding Relationships. Warren Buffett often emphasizes that compounding is not limited to money. Relationships, trust, and partnerships can also grow over time, creating opportunities and advantages that last a lifetime. Just as small investments grow into large sums through patience, small acts of honesty, respect, and collaboration can compound into meaningful connections. Buffett values long-term relationships with business partners, managers, employees, and friends. He treats people fairly, keeps promises, and maintains integrity. This approach builds trust, which multiplies over time. People want to work with him, share opportunities, and support his decisions because they know he is reliable and principled. In business, these relationships create advantages. Companies with strong partnerships can negotiate better deals, attract top talent, and maintain loyal customers. Employees are more committed when they trust leadership. Suppliers, clients, and collaborators prefer to work with people they respect. These connections are like invisible moats, protecting the business and enhancing growth. Buffett also compounds relationships through mentorship. He helps talented individuals grow by giving them responsibility, freedom, and guidance. For example, the managers of Berkshire Hathaway's subsidiaries operate independently, but Buffett supports them and provides advice when needed. This mutual respect strengthens loyalty and ensures that decisions are made in the company's best interest. Trust and integrity are the foundation of compounding relationships. People remember how you treat them. If you act fairly and honestly, your reputation grows and opportunities multiply. If you betray trust, the damage can last for years and block future growth. Buffett's lifelong emphasis on ethical behavior ensures that his relationships remain strong over decades. These principles apply to personal life as well. Building friendships, networking, and maintaining family connections are investments in your own social capital. Every act of kindness, support, or cooperation adds value over time. Just like money, relationships grow through consistent, positive actions. Buffett also recognizes the importance of patience in relationships. Strong connections do not form overnight. They require trust, repeated positive interactions, and shared experiences. Just as you cannot rush compounding wealth, you cannot rush meaningful relationships. Another important lesson is reciprocity. Buffett helps others succeed without expecting immediate rewards. Over time, these acts return benefits, often in unexpected ways. A network of strong, trusting relationships provides insight, opportunities, and support that no money alone can buy. In investing, strong relationships help identify good deals, attract talented managers, and navigate challenges. In life, relationships create a support system, open doors, and build resilience. Buffett treats relationships like long-term investments, nurturing them steadily and patiently. Compounding relationships also reduce risk. In business, trust lowers the chance of disputes, misunderstandings, or unethical behavior. In life, it creates stability and support during challenges. The benefits of these connections grow quietly but powerfully, often multiplying over decades. Buffett demonstrates that money is important, but relationships are equally valuable. They compound in ways that create lasting influence, opportunity, and success. By focusing on integrity, trust, and long-term collaboration, anyone can build a network that strengthens both personal and professional life. Now that we understand the importance of relationships, the next chapter explores another key principle: knowing your limits. Buffett teaches that understanding your strengths and weaknesses is essential for success in investing and in life. Chapter 15: The Circle of Competence. Warren Buffett emphasizes that one of the most important rules in investing is to stay within your circle of competence. This means focusing only on businesses, industries, or areas you understand deeply. If you do not fully understand how a company makes money, you should not invest in it. Knowing your limits is a key factor in avoiding unnecessary risk. Buffett compares investing to a game. You do not need to be an expert in everything. You only need to play within your strengths. By concentrating on what you know, you can make better decisions, avoid mistakes, and achieve superior results. Trying to invest outside your circle of competence increases the chance of error, stress, and losses. Understanding your circle of competence requires honesty. You must be willing to admit what you do not know. Many investors pretend to understand trends or industries they barely know. Buffett warns that overconfidence is dangerous. It can lead to impulsive decisions and poor investments. Buffett applies this principle in his own life. He invests in businesses he understands well, such as consumer products, insurance, and finance. For decades, he avoided technology companies because he did not fully understand their long-term prospects. This careful focus allowed him to identify opportunities where he had knowledge and confidence. Defining your circle of competence also requires constant learning. Your circle can grow as you gain knowledge and experience. Buffett spends hours reading, analyzing, and thinking to expand his understanding of industries and businesses. The more you learn, the wider your circle becomes, but only after you truly understand the subject. Buffett also uses this principle to reduce stress. When you operate inside your circle, you can make decisions confidently. You do not panic when the market fluctuates because you understand the underlying business. You make choices based on facts, not speculation. A circle of competence also helps in risk management. By avoiding areas you do not understand, you reduce the chance of investing in weak or risky businesses. This discipline prevents losses and protects long-term wealth. Buffett's rule does not mean avoiding opportunities entirely. It means waiting until you understand an opportunity before acting. Sometimes a new industry, technology, or trend may seem appealing. If you take the time to study it and fully understand it, it can enter your circle of competence. Until then, it is wise to wait or ignore it. This principle also applies to personal skills and life decisions. You should focus on areas where your knowledge, talent, and experience give you an advantage. Trying to do everything or follow every trend spreads effort thin and increases mistakes. Mastery comes from focusing where you have strength. Buffett often says that knowing your circle of competence gives you confidence. It allows you to make decisions independently of others' opinions. You do not need to follow trends, rumors, or market hype. You make choices based on knowledge and understanding. By combining a clear circle of competence with patience, emotional control, and long-term thinking, investors create a powerful advantage. It ensures that decisions are rational, calculated, and aligned with real understanding. Now that we understand the value of knowing your limits, the next chapter explores another critical principle: the role of time in investing. Buffett teaches that time is one of the most powerful forces in growing wealth, and those who respect it gain enormous advantages. Chapter 16. The Role of Time. Warren Buffett often says that time is one of the most important factors in investing. He believes that the earlier you start, the greater your advantage. Time allows investments to grow, profits to compound, and knowledge to accumulate. Even small amounts of money, invested wisely, can become significant over decades. Buffett's own journey shows the power of time. He began investing as a young boy, buying his first stocks as a child. Over the years, he continued learning, investing, and reinvesting profits. By the time he was an adult, his early investments had grown substantially, giving him a strong foundation for future wealth. This is the magic of starting early and letting time work. Compounding works best over long periods. Profits generate more profits, and the growth accelerates. Short-term fluctuations become less important, and steady growth becomes dominant. Buffett says that the most important quality for an investor is patience. Time rewards those who wait, study, and hold strong businesses for the long term. Time also allows mistakes to be corrected. Even the best investors make errors, but when you think long term, mistakes do not destroy wealth immediately. You can learn from them, adjust strategies, and continue growing. Rushing or seeking immediate results increases risk and often magnifies errors. Buffett also uses time to his advantage by focusing on long-term investments. He often holds stocks for decades. This approach reduces the impact of short-term market volatility. It allows the true value of a business to show itself over years. Time turns good decisions into great results. Another aspect of time is knowledge accumulation. Buffett reads constantly and reflects on experiences. Each lesson learned adds to his understanding and improves future decisions. Time allows wisdom to compound just like money, making him a better investor year after year. Time also plays a role in relationships. Buffett emphasizes long-term partnerships with business managers, employees, and partners. Strong relationships, nurtured over years, create trust, loyalty, and collaboration. These connections multiply opportunities and advantages over decades. Buffett's respect for time also shows in avoiding short-term distractions. He does not try to predict daily market movements or react to temporary trends. Instead, he focuses on the long-term potential of companies. He says, "Our favorite holding period is forever." This mindset allows him to benefit from compounding and reduces stress from market noise. Time also teaches humility. Even the smartest investor cannot predict everything. Buffett accepts that markets are unpredictable in the short term, but he trusts that strong businesses will succeed over time. Patience becomes a competitive advantage when others act impulsively. In life, the role of time is equally important. Skills, knowledge, relationships, and habits all grow over years. By starting early and being consistent, you create exponential benefits. Rushing or seeking shortcuts rarely produces lasting results. Understanding the role of time strengthens all other Buffett principles. Patience, discipline, emotional control, and long-term thinking become far more effective when combined with the power of time. The next chapter builds on this idea. Buffett believes that before investing in businesses, one should also invest in oneself. Time spent on self-improvement and learning yields the highest returns. Chapter 17. Invest in yourself first. Warren Buffett often says that the best investment you can make is in yourself. Skills, knowledge, health, and personal growth create the foundation for success in business, investing, and life. Money can come and go, but your abilities and habits are permanent assets that compound over time. Buffett believes that self-improvement is the key to long-term advantage. By learning new skills, gaining knowledge, and improving judgment, you increase your ability to make good decisions. Education, reading, and practice are all investments in yourself. Even small efforts, repeated consistently, can create enormous benefits over years. Reading is one of Buffett's main tools for self-investment. He spends hours each day reading books, newspapers, and reports. This habit expands his knowledge, sharpens his thinking, and improves decision-making. Investing in your mind creates skills that can be applied in business, investing, and everyday life. Buffett also emphasizes emotional development. Self-control, patience, discipline, and resilience are critical for success. Investing in your emotions allows you to remain calm in market swings, avoid impulsive decisions, and take advantage of opportunities when others panic. This emotional strength compounds over a lifetime, just like financial investments. Health is another form of self-investment. Without physical and mental well-being, long-term success is difficult. Buffett recognizes that maintaining health, energy, and focus is essential to achieve goals consistently over decades. Investing in yourself also includes understanding your strengths and weaknesses. Buffett teaches the circle of competence. Know what you do best and focus there. Improving your skills within your strengths increases your effectiveness. Understanding your limits reduces mistakes and guides wiser decisions. Another important area is networking and relationships. Buffett invests time and energy in building strong, trustworthy relationships. These connections create opportunities, provide guidance, and offer support. They compound over years, giving benefits that money alone cannot buy. Self-investment also includes financial literacy. Understanding money, business, and markets improves your ability to grow wealth. Buffett advises learning about accounting, valuation, and economics. Even basic understanding gives an edge in identifying opportunities and avoiding mistakes. Buffett believes in lifelong learning. The world changes, industries evolve, and new opportunities appear constantly. Those who continue learning adapt and thrive, while those who stop grow stagnant. Investing in yourself means committing to growth and knowledge every day, without pause. Investing in yourself yields the highest returns because it is under your control. You cannot always control the market or the economy, but you can improve your skills, knowledge, and habits. Over decades, these investments multiply, giving you confidence, competence, and the ability to seize opportunities. Buffett's approach shows that personal growth is inseparable from financial success. Wealth grows faster and more safely when built on a strong foundation of knowledge, skills, relationships, and character. The next chapter explores another critical lesson: giving back. Buffett teaches that wealth is not just for personal gain. Sharing knowledge, time, and resources creates impact beyond money. Chapter 18. Giving back. Warren Buffett believes that wealth is a tool, not an end in itself. He teaches that giving back to society, supporting communities, and helping others is as important as earning money. True success is measured not only by financial achievements, but also by the positive impact you create in the lives of others. Buffett has pledged to give away most of his fortune to charitable causes. He does this not for recognition, but because he understands the responsibility that comes with wealth. He believes that money should be used to improve education, health, and opportunities for people around the world. This mindset reflects his values, integrity, and long-term vision. Giving back also strengthens communities. When successful people share resources, knowledge, and time, others can grow and succeed. Buffett's philanthropy encourages learning, entrepreneurship, and social progress. He often says that helping others creates a cycle of opportunity, benefiting generations beyond the immediate act. Buffett also teaches the importance of ethical wealth creation. Making money honestly and fairly ensures that your success is sustainable. By acting with integrity, you gain the trust of others and create a strong foundation for giving back. Unethical or short-term gains may bring wealth quickly, but cannot sustain long-term impact. Philanthropy is not only about money. It includes sharing knowledge, mentoring others, and supporting causes that align with your values. Buffett frequently shares his wisdom with young investors, business leaders, and students. His guidance multiplies far beyond his personal wealth, creating a ripple effect of learning and growth. Giving back also enriches personal life. Helping others provides purpose, fulfillment, and perspective. Buffett often emphasizes that true happiness comes from contributing to something larger than yourself. Wealth becomes meaningful when it serves a purpose beyond personal comfort. Buffett's approach to giving back also highlights planning and responsibility. He carefully chooses how to distribute resources to maximize impact. Charitable decisions are strategic, thoughtful, and aligned with long-term goals. This principle mirrors his investment approach: careful analysis, patience, and focus on results. Another lesson is that generosity strengthens reputation and influence. By giving back, Buffett sets an example for others to follow. This inspires trust, collaboration, and positive change in both business and society. Leadership through action reinforces values and leaves a lasting legacy. Buffett combines giving back with humility. He avoids extravagance and publicity for personal glory. Instead, he focuses on meaningful contributions that improve lives and create opportunities. This humility reflects his long-term mindset and his focus on enduring impact. In life and investing, Buffett shows that wealth is a tool for growth, security, and contribution. Accumulating money is important, but using it wisely amplifies its value. By giving back, you create a cycle where knowledge, resources, and support generate lasting benefits for others and yourself. Ultimately, Buffett's philosophy teaches balance. Financial freedom, knowledge, patience, and relationships are valuable, but their true purpose is to create a better life for you and those around you. Giving back completes the cycle of wealth, turning personal success into positive societal impact. With this principle, all of Buffett's lessons come together. Patience, discipline, emotional control, simplicity, long-term thinking, investing in yourself, and ethical behavior combine to create lasting wealth. This wealth is most meaningful when it serves others, leaving a legacy of value beyond money. The next chapter emphasizes learning from mistakes, showing that even Buffett's journey includes errors, but these errors are stepping stones to greater wisdom. Chapter 19. Learn from mistakes. Warren Buffett often says that everyone makes mistakes, even the most successful investors. The difference between a successful investor and an unsuccessful one is how they handle their errors. Mistakes are inevitable, but learning from them is essential for long-term success. Buffett treats mistakes as lessons, not failures. He analyzes what went wrong, why the decision was made, and how it can be avoided in the future. This honest evaluation strengthens judgment, improves decision-making, and reduces the chance of repeating errors. Acknowledging mistakes requires humility and discipline, qualities Buffett values highly. One example from Buffett's career is his investment in Berkshire Hathaway itself. He initially bought shares because he thought it was a good textile company. However, the business was declining, and it turned out to be a poor investment. Instead of panicking or selling in haste, Buffett learned from the experience. He used the situation to understand business fundamentals better and eventually transformed Berkshire into a holding company for successful investments. Buffett also emphasizes that mistakes are not always financial. Errors in judgment, emotion-driven decisions, or ignoring rules of investing are equally important to analyze. By reviewing these errors, investors can strengthen their mental frameworks and make smarter choices. A key part of learning from mistakes is avoiding emotional attachment. Investors often feel embarrassed or defensive when an investment fails. Buffett teaches that ego has no place in investing. By separating identity from investment decisions, you can objectively study errors and correct behavior. Buffett also highlights the value of preparation in reducing mistakes. By thoroughly understanding a company, its management, and its industry, you reduce the chance of errors. Even with preparation, some mistakes are unavoidable. The important part is using them as learning opportunities rather than letting them demoralize or mislead you. Learning from mistakes also reinforces other Buffett principles. Emotional control prevents panic when things go wrong. A long-term mindset allows time for recovery. Focusing on your circle of competence ensures you avoid areas where errors are more likely. Patience, knowledge, and discipline turn mistakes into stepping stones rather than obstacles. Buffett encourages a mindset of continuous improvement. Every mistake provides insight into behavior, decision-making, and strategy. By systematically studying errors, investors create a personal guide for better decisions in the future. This process compounds knowledge, just like financial investments compound wealth over time. He also teaches that sharing lessons benefits others. Buffett is open about his errors, allowing investors, students, and business leaders to learn from his experiences. This openness reinforces the idea that mistakes are natural, valuable, and necessary for growth. In essence, mistakes are not failures, they are part of the journey. The most successful investors recognize them, learn quickly, and adjust their approach. Buffett's philosophy shows that errors, when handled properly, strengthen judgment, increase resilience, and enhance long-term results. Now that we understand the importance of learning from mistakes, the final chapter ties all of Buffett's lessons together. It shows how his principles create a lifestyle and mindset for success that goes beyond investing. Chapter 20. The Buffett Way of Life. Warren Buffett's investment strategies are not just about money, they reflect a broader way of life. His principles combine discipline, patience, integrity, and long-term thinking into a philosophy that guides both investing and living. At the core of the Buffett way of life is simplicity. Buffett avoids unnecessary complexity in business, investments, and personal life. He focuses on what is understandable, manageable, and sustainable. By keeping things simple, he reduces stress, avoids mistakes, and maintains clarity in decision-making. Patience is another key element. Buffett waits for the right opportunities and holds investments for decades. He does not chase short-term gains or trends. This long-term perspective applies to life as well. He invests in knowledge, relationships, and personal growth, allowing time for these efforts to compound into meaningful results. Emotional control is central to Buffett's philosophy. He does not react impulsively to fear or greed. He ignores market noise and focuses on fundamentals. In life, this translates to measured decisions, resilience in difficult situations, and consistent effort toward long-term goals. Integrity and trust are also pillars of the Buffett way. Buffett treats people fairly, honors commitments, and values honesty. This behavior strengthens relationships, reputation, and opportunities over time. Whether in investing, business partnerships, or personal interactions, trust compounds into influence and lasting success. Continuous learning is a lifelong habit. Buffett spends hours reading, analyzing, and thinking. He invests in himself constantly, knowing that knowledge and judgment improve over time. This commitment to self-improvement applies not only to investing, but to every aspect of life. Another principle is living within your means. Buffett avoids unnecessary debt and extravagant spending. Financial freedom allows him to act rationally and focus on meaningful investments. It also reduces stress and creates the ability to take advantage of opportunities when they arise. Buffett's generosity completes his philosophy. He gives back through philanthropy, mentorship, and ethical leadership. Success is not just personal wealth. It is the positive impact you create for others. This generosity reflects a long-term view of legacy, influence, and responsibility. The Buffett way of life also emphasizes relationships. Trustworthy partnerships, loyal employees, and strong family connections provide support, insight, and opportunities. By nurturing relationships patiently and consistently, benefits compound over time, just like money. Learning from mistakes is another aspect of Buffett's approach. He analyzes errors, accepts responsibility, and improves decision-making. This continuous reflection strengthens judgment, reduces risk, and increases the probability of long-term success. Ultimately, the Buffett way of life is a combination of principles applied consistently over decades. It is not about shortcuts, luck, or trends. It is about discipline, clarity, patience, integrity, learning, and generosity. These values guide investing decisions, personal growth, and life choices. Anyone can adopt elements of this philosophy. Start by investing in yourself, controlling emotions, avoiding unnecessary debt, and focusing on long-term value. Practice simplicity, maintain integrity, nurture relationships, and give back when possible. Over time, these habits compound into wealth, wisdom, and fulfillment. The final lesson of Buffett's life is that success is a journey, not a destination. Financial freedom, knowledge, relationships, and personal growth are all intertwined. By applying these principles consistently, you can create a life of purpose, security, and lasting impact. This concludes the journey through Warren Buffett's investment strategies and philosophy.